Hey guys, how are you doing today? How are you doing today? It's another day in paradise, huh? It's another day in paradise. Welcome, welcome, welcome to your Tuesday videocast. Welcome to our Tuesday videocast. My name is David Etienne, owner CEO of Etienne Business Solutions. We're a certified public accounting practice, and we meet here every Tuesday at 8 p.m. Yep, at 8 p.m. for our video cast. Okay, and so you can check us, of course, check us on our website, but more importantly, you need to check us on our YouTube channel, which is Etienne's Place. Etienne's Place, because that is where you're going to get all the good stuff, all the the video casts that we do and the videos that we post. There's a lot of things there, so I invite you to go check them out. Check them out. Subscribe, like, and hit the notification button so that once we are we are on air live, or there's a new video posted, you will be notified. Good. Without further ado, so we are on this topic of IRS collection process, and last week we looked at several stages and phases. Essentially, we're looking at the series of correspondence that the IRS will send out to taxpayers before they actually reach the point of collections. Okay, so we went to several of them, and we ended last week at CP90. CP90, we remember it has to do with that critical position where that correspondence is basically saying that the IRS intend to levy your bank account, levy your wages, and put lien against your bank account, etc., etc. So that is where we reach to that very serious and critical point. So moving from CP90, I just thought I would add one more thing to the CP90 thing, is that sometimes you have individuals who are in receipt of social security benefits. Now that's a critical one, because you find that taxpayers receiving social security benefit can now get a CP91, and that CP91 is essentially advising such a person that the IRS is intending to levy 15% of their social security benefit towards any tax debt, any taxes owed. I repeat, very important, there's a there's a CP91, and this is a correspondence sent to taxpayers who are in receipt of social security benefits, and this CP91 correspondence advise such a person that the IRS intend to levy up to 15% of your social security towards whatever tax debt you have. Now, obviously, for most persons receiving social security, that's a major hit, that's a major blow. And so if you fall in that category, you certainly do not want to have that letter sent to you. So that's where we're at. Now, in all of this, I don't remember if I'd mentioned it last week. In all of this, there's what we call the taxpayer bill of rights. So, enclosing in the envelope, and this applies to early, with the earlier correspondence. Included or enclosed in the envelope that have these various correspondence, IRS correspondence, you have a little brochure, a little printout that basically is headed Taxpayers Bill of Rights, and it is very important because it outlines the taxpayer's right, to several things. So it's not like you're a lamb to the slaughter, so to speak. While the IRS is going through its process of issuing notices, there's also the opportunity for you, the taxpayer, to exercise your rights, so that you have a fair hearing, etc., etc. So it's always important for you to look at that document called the Taxpayer Bill of Rights to see exactly what you're entitled to. I think I done a video on it some time back, so you should be able to find that on Etienne's place. Okay, so let's move in right along. So we reached to where we had with CP90, and there's the intent to levy and garnish wages and all of that good stuff. At that point, you can say yes, you are fully in what we call collection mode. The IRS is fully in collection mode because they are now taking steps to get their money. So they are in full-fledged collection mode. Okay? At that stage, it means that you as a taxpayer, you need to be aware and to take action that is provided to you if you had not done so earlier under this Taxpayer Bill of Rights, because one of those rights is the right to a fair hearing. Okay? So picture this. You are at this point, and so your account is in collections. The IRS is really getting down on you now because we have reached to that point. It is in collections. You are able to, or you're allowed to, or there's a provision for you to appeal, like any other appeal. It's a case, and you want to put in an appeal. Okay? An appeal. So this appeal can be based on whether or not you think the amount that is assessed is incorrect, or for whatever reason, you can and you should, once the opportunity lends itself, to submit an appeal. So bear in mind that this huge organization called the Internal Revenue Service has different departments dealing with different components and stages of the collection process. So we have what we call collections department. And so your account would be in collections because it has reached to that point because of all those earlier notices that were not attended to, addressed. And so you're now in collections. However, you're able to file an appeal. So the document that is sent you, that CP90, usually there's a letter that indicate that if you wish, you can file an appeal, and you need to file the appeal within the stipulated timeline, because if you pass the deadline to file the appeal, then you have forfeited that opportunity or that right. So you have a time in which to file an appeal. Now the good thing about an appeal, among other things, yes, is that once you submit an appeal, then your tax account, your tax debt, moves out of collections to appeals. Because as I indicated earlier on, different departments deals with different components of the whole process. So if you're in collections, then when you call, you'll call collections to deal with that department in terms of making arrangements to pay or whatever the case is. If you file an appeal, then you're going to have your file, your matter moved from collections to appeals. No, it's a separate department that deals with appeals. It's the appeals department. Okay? So that is one thing. Usually, when you file an appeal, submit an appeal, then that request will have now to be assigned to an officer, a revenue agent, who is going to be now the dedicated officer handling that matter. Okay? So all your correspondence, all your communication is going to be with this person or through this person. Because remember, once you submit an appeal, you need to indicate and establish the basis on which you are appealing. What are you asserting? What are you defending? What are you disagreeing with? Because the appeal can't just be in the sky. It has to be based on some foundation, whether it is something that you assert, whether it is a bit of fact that you have, something you disagree with, whatever the case is. So, based on this, based on the basis, huh? Based on the nature and basis of your appeal, then you'll naturally be required to submit supporting documentation, supporting information, supporting evidence to defend or to support your case, your appeals. And all of that will flow through to that agent, that officer that is handling your case. You recall I'd said when we went through all those other correspondence when we met last week, I indicated that roughly you talk about 30 to 45 days would elapse between each of the correspondence. So when you look at correspondence 1 through to CP90, you have had quite a while to get your house right. Now when you file for when you submit an appeal, really, that file or your file will have to be assigned to an appeals officer. That can take some time. Because, believe it or not, the IRS is pretty overwhelmed with a lot of these matters and appeals coming in, and so it takes some time to have your file assigned and for action to start rolling on that. So you could easily take 4 to 6 months between the time that you submitted the appeal until you receive a letter that introduces you to the agent, and then that person will now be in communication with you, gathering information, gathering document. Okay, so that 4 to 6 months is again another chunk of time that you have available at that stage. Significant to the process is once you have your matter, your case, your file moved from collections to appeal, then it is similar to what we call a stay of execution. Because once your case is in appeals, it means that there's an open matter, there's an open case being deliberated on. There's an open case in process that is being investigated, and you are now submitting evidence or information to defend your position, etc. So with that said, no further collection action will be taken. Now you cannot be collecting while the thing is going through appeals, because appeal is basically a stage where we're going to say, no, this is not so, or there's a different side to the story, or I have some evidence to prove that what you're claiming is wrong, whatever the case is. So at the appeal stage, naturally, the collection process comes to a stop, a dead stop. So that again, by this, give you some more time to deal through the appeals process. So there's no further letter coming at you, collection. No, because you're now at the appeals stage. Now there's a letter called CP523. And we'll look at that a little later again, because once we move from this phase, and I suppose by next week we'll be looking at the whole, when you have exhausted all the appeals and that kind of thing, and if it is determined that yes, you do owe this tax bill, then what are the options available to you? One of the options, of course, is just to pay it outright, but then there are other accommodations that the IRS has for taxpayers to help you to address that tax bill. But we'll come to that. But that will be covered like on a CP 529 with installment agreement and that. But just to preempt it, if you were in an installment agreement, a payment plan with the IRS, then 3 things are important to note. A payment plan naturally is to help you to pay off this tax debt over time. That's true. What it requires is that for all subsequent years, let us say you owe these taxes for 2018, then for all years subsequent to 2018, you're expected not to owe any more taxes. If you have a tax debt, you need to pay it up. Because if you have future years of unpaid taxes, that will definitely cause your installment plan or your payment plan or your installment agreement to lapse. All right, very important. And that letter that I mentioned, which is letter CP523, is that letter that will inform you that your installment agreement or your payment plan has lapsed because of you having tax debt unpaid in subsequent years. That's one thing. The other thing, of course, that will cause it to lapse is that you default on your payments. A lot of times we set up payment plans and we're going on strong, but for one reason or the next, you default. You have 2-3 months unpaid, and the plan goes through the window. You will also receive a CP523 advising you that the plan is cancelled. Okay, plan is cancelled. But going back to this collections, moving to appeals department, we said first, yes, it moved out. It moved from collection to appeal. Once there's an appeal, then all collection action will cease. So you're given some time as you go through this process. We want to touch now on two matters that are critical. And I think I had put it up here straight from the IRS website just for reference. Okay. Now, although we're talking about a series of communication, a series of letters, that was not always the case. There was a time way back when the IRS's policy was take action right away and have a discussion later. Yeah. So there was a time when no series of letters was sent out to taxpayers advising and reminding. No, that was not the case. Once you have a tax debt or a tax bill, the IRS would have just moved to collect, because their motto is we are acting in the best interest of the federal government. And naturally, the best interest of the federal government is served by the agents or the IRS as a body moving to collect outstanding taxes that ought to be filtered into the government's coffers. So that was the mode of operation. But and I'm looking at it here, it was 1998 when they had the Restructured and Reform Act, where it was decided, okay, let's not be so draconian, let us now put in place a process of communication, correspondence to allow taxpayers what they call an even playing field. So if everybody is getting letters and letters, then people would be in the same position to act or to ignore. Because in the past, because the IRS was just moving in, then there was a bit of discretion as to who the IRS move on to right away, or who they give a couple of weeks or a couple of months. So there was a little bit of imbalance there. So with this Reform Act came the whole series of letter system. So everybody will receive their letter and be able to respond accordingly. Good. Now, although we have a series of letters that facilitate the taxpayer that owes the debt to make good on it in good way, in good time, there are two important things to know. And there are two cases where the IRS has the option and has exercised its right to bypass all these letters and go straight to collections. Yeah, straight to collections. Okay? There are circumstances where the IRS will bypass. So you won't get notice 1, reminder 1, notice 2, reminder 2, intent 2, plan 2. No. It will move straight to collections, which is almost like at the CP90 stage. Why is that so? Two cases. One is what we call a jeopardy levy. Jeopardy levy. Fancy term, but very simple concept. If for whatever reason, the IRS is of the view that this person who is owing this tax bill or this tax debt have some intention or is likely to find a way of moving funds out of an account that the IRS would naturally tap into, or the person is intending to, well, let's call it repatriate funds, send funds to some foreign accounts, etc. But either way, if it is the IRS's view that this taxpayer may intend to take some action to deny the IRS or the federal government from being able to collect the taxes, then as you can understand, expedience is the order of the day. You don't want to be sending letter, then 30 days later, a second letter, and a third letter to give this person all the time in the world to shift the resources out of this account, out of the country, you name it, liquidate whatever, and so deny the IRS from being able to collect. So again, if the IRS for whatever reason is of the view or get the feeling that this person may just try to find a way of masking, concealing, hiding the funds, then we can't go through the letter system and give him time to do that. We have to move right away. So in that case, the IRS will bypass the letter series and go straight to collection. That's one. Secondly, we're talking about taxes and taxes owed, and most of the time we're looking at taxes owed by individuals. There's a case where, well, not a case, where taxes are also owed by entities. Now, it can be corporate tax, it can be sales tax, but quite often it is employment tax. Employment tax. And usually the employment tax has, three components. There is the income tax, which is a tax that is taken out of the employee's salary. There is the Medicare, which is again a piece that is taken out of the employee's salary. Okay, there's a Social Security, a third piece that's taken out of the employee's salary. Yes, it is a requirement that the employer should match the Social Security and the Medicare. So when the company is paying over payroll taxes, it pays over a lump sum, but that lump sum is made up of income tax from the employee, Social Security from the employee, Medicare from the employee, and the employer's match of the Social Security and Medicare. That is what goes over to the IRS. So you can understand and appreciate that if the tax outstanding is payroll tax, it is different in a significant way. It is different from when an individual owes taxes, because remember, the company, your employer, would have taken from your salary income tax, taken Social Security, taken Medicare from your salary, okay? And your employer in that stage and phase is really a custodian. It's really a custodian. It's almost like an escrow account. So the company is taking it out of your salary and is supposed to remit it to the IRS, to the federal government. So for employers who fail to hand over these funds, but use it in operations, then it is a very serious offense, because not only are you, the company, not paying your taxes, you're actually taking employees' taxes and Social Security and Medicare that you ought to pay over on their behalf. Because remember, when your Social Security deduction is made from your salary, it goes into your Social Security account for later years. Medicare into your Medicare account, so to speak, so you can get the benefit. So when your employer takes it out and do not remit to the IRS, then hey, there are two components. Yes, the company is not paying its taxes over, or it's matching, but more seriously is the fact that they are holding on to your money and therefore not funding your Social Security Medicare account. That is serious, and in such an event, as before, the IRS may say, okay, this is a serious matter. We're not going to go through the whole step by step, letter 1, letter 2, letter 3. No, we're not doing that. We're going straight to collections because we will not exercise any leniency when an employer has taken from an employee but not hand over, which happens quite often. And the truth be told, especially for small employers, in most instances, the intention is not really to keep those funds for operations. It's really, I'm not excusing it, but the reality is that sometimes an employer will have like a cash flow problem, need to pay for some supplies, need to pay some bills, have the payroll taxes there, and say, okay, let me just quickly pay these bills, this supply, and by the next time I'll pay it over. But then the danger about it is that it happens for the first payroll, you did not get to make good on it. The second payroll comes, the third payroll comes, and the same thing happens. Before you know it, you have a whopping bill unpaid, and trying to catch up is quite a challenge, can be quite difficult. And so a lot of smaller, especially smaller employers find themselves into that rut. Okay, but those are the two cases where the IRS will say, yeah, we're not going through the letter series, we're just jumping straight to collections because somebody may want to find a way to hide the funds, or on the other hand, an employer having deducted from an employee is holding those funds. And so that's a no-no. That's a no-no. Cool. So if you notice, therefore, we have reached to that point where we have outlived all accommodations, and now it is time for collections. And I said earlier on, the best things to do is to move to appeals. And I mean, the appeal process is not something you're just going to because you're trying to just buy time or to get some more time, because usually when you submit an appeal, then you usually indicate the basis on which you're appealing. So I'm appealing this because I disagree with this number. And if you say I disagree with number, what about the number you disagree with? I agree with component A of, that makes up the number. Well, if you disagree with that, you need to provide A, B, C, D, E, F, G supporting documents or information to defend your case. So it's not just an arbitrary thing just to delay the process. Okay, cool. So that is where we're at this point, and I'm just looking because I want to ensure that we cover everything up to this one, because once we move forward, we're going to look at a case now where you have gone to appeals, the appeals process went through, and one of two things can happen. Well, one of three things can happen. You are successful in the appeal, meaning that whatever evidence, documentation that you provided to defend your position or your assertions, they were satisfactory, they were accepted, and so they are say, okay, you're right, so you're good, we get rid of this. It was an error, or it was a misstatement, or it was a doubling up of numbers, whatever the case is. But that's one possible outcome, that the bill is totally, you're exonerated, and so the bill, it goes. You're free to go. That's one possibility. The second possibility is where you may have been, you may be claiming several things, but you're only able to satisfactorily defend 1, 2, 3 out of maybe 5 items. And so yes, you end up getting some adjustments to the bill, but it's not like you're able to clear cancel all the total bill. But the things that you successfully defended cause the bill to be revised down. So you, instead of owing 10,000, you may end up owing 4,500 now, because you argued and documented away the difference. The other option, of course, is where, we went through the review process, we looked at all the documentation you provided, listened to all the new information that you gave us, but none of them convinced us or gave us enough evidence to prove what you're trying to defend. And so whatever the bill was up to the point of collection, that remains. That figure remains. Now, important. If that bill was 10,000 at the point when it went to appeals, yes, no further collection action is taken, but it is sitting at 10,000. Now, when you go to appeals, if it is a third scenario that represents the outcome where nothing has changed, nothing has changed, okay? Then what you find is that 10,000 that was quote unquote frozen in time when the appeals process started, that 10,000, and if the appeals take say 9 months to be completed, don't you think that at the end of the appeals process, which is 9 months later, that you still only owe 10,000 that you owed 9 months earlier when there was a freeze on collection? No, because the fact that you have now failed at the appeals stage, it means that you still definitely owe this 10,000, and so the 10,000 would have continued earning interest and penalty and whatever from that day. So when you come to the end of the appeals process and you're told no, nothing happening, the bill remains the same, then bear in mind that that bill would have gone up some by accumulated or accrued interest and penalty during the time when it was frozen. All right, frozen. So all of that has to be taken into consideration. So let us say you have done everything you can, and if appeals is over, you have an adjusted tax bill, or the tax bill was not changed by $1, so you now come to the point where the IRS is saying, yes, you have to pay. So now we come to that point of pay now, or make some arrangement to pay. Because what I want you to bear in mind is that during the appeals process, you are presenting information and documentation and evidence to show that you do not owe this amount or any of it. Now that the appeals process is over and no change has resulted, it means now it is time to collect. Time to collect. So you can either take out your checkbook, write a check, get it over with, or you can then tap into some of the resources and the accommodations that the IRS has for persons owing debt. So at that point, you're not questioning or disagreeing with the bill anymore. It is a given. It's a given. But you see, it's interesting. After all those letters and even the appeals process, and you come to the point where it is determined that yes, you owe this bill of $10,000, even then, there's still additional provisions and accommodations as to how you're going to pay this bill. Because you can say that, all right, yes, it is 10,000, I'm agreeing, yes, it is true, that's what I owe. But the point is that I do not have the resources. I cannot just find $10,000 to pay you. What are my options? Then that is when we go into the various options provided to taxpayers to settle the bill. Okay, the shortest, quickest, least expensive is, yes, if you can just write a check, pay it over. But a lot of us can't do that, and depending on the amount. So that is when now we'll be looking at the various programs that the IRS has to facilitate taxpayers to settle their tax debt. Okay, that will be the subject of next Tuesday's video cast. So right now we have come to that place where, yes, right through the process, down to collections, we make an appeal, the appeal is ended, we still end up owing some money, whether the same figure or a reduced number, but we owe money. It is now time to pay. So come next Tuesday, we'll be looking at that process or those programs that will help the taxpayer to make payment. All right. So that's it for today. And I remind you just to check my YouTube channel. Sometimes, some of my clients, friends, associates, busy people, you may not have caught the live video cast, and so you can always check back on my Etienne YouTube channel, Etienne's Place, and you'll be able to get up to speed with what was discussed. All right, so that's it for now, people. So next Tuesday when we come, we're gonna dive right into those programs. Here people talk about fresh start, and people talk about installment agreement, people talk about offer in compromise, people talk about uncollectible status, and all those terms and those programs are there to facilitate you, the taxpayer. So all right guys, that's it. David Etienne saying bye for now, and I see you next Tuesday at 8 p.m. where we'll continue this very important and somewhat very interesting topic. Bye for now.